Deals, rates, and terms all have their special snowflake moments, but you want to know what matters the most in a deal? We help break that down in this episode.
Rates versus terms. What's going to have the biggest impact on an investor when they're first starting out? What do you think about that?
Yeah, I think especially newer investors, I think get maybe into the weeds a little too much on this. So we wanted to kind of highlight the moving parts of it. Let's get into the weeds of, what is an amortization? So amortization is, let's just say we're looking at a 30-year fixed mortgage. That means that loan is amortized over 360 payments. And so that's how your principal and interest payment is calculated based on the interest rate and the term of the loan. And so if you go with a shorter amortization, say like a 20-year, your payment's going to go up, but also in a lot of cases, your interest rate's also going to drop a little. But I think too often, this is not a huge factor in our space because most of our DSCR lenders are going to focus on just standard 30-year fixed mortgages. So very similar to your conventional loan, not any kind of special product or anything like that. I think especially with DSCR being a product that's not utilized as much as a conventional one, I think people are always questioning, hey, is this different than what I'm traditionally looking at from like my primary residence? So term is something to be mindful of. If it gets shorter, because that could affect your cash flow as that monthly payment would increase. But I wouldn't say it's a huge factor. What about rates?
Yeah. So, as you mentioned, on a 30-year fixed rate, you're typically going to be a higher rate than maybe a 20-year amortized loan. But when you look at the details of that, like, well, how does that impact cash flow? Because sometimes people get fixated on rate, like, oh, there's a 20-year loan, but it's a cheaper rate. Okay, cool. Well, what's important to you? Is cash flow important to you? So let's say cash flow is important to you. So let's say you're at a loan amount of $150,000 and you're at 8.5% on a 30-year fixed rate. The monthly payment on that, just principal and interest, is going to be $1,153.37. So $1,153.37. Let's say you go and you find a 20-year amortized loan at 7.5%, so a full point lower, but it's 20 years. How does that impact the payment? Goes up. It goes up $55. You're at $1,208.39.
Yeah.
So you're $55 more expensive each month for that shorter period. Now, typically, I would say, okay, because as you said, DSCR loans, they're going to be typically 30-year fixed rates across the board. When do we run into 20-year amortization periods? Commercial, yeah. So, and in those, sometimes you're going to be fully amortized, meaning both your term and your amortization is going to be 20 years. But more often than not, you're going to have a shorter term than the amortization period. So you might see something where the loan term is only 5 years with a 20-year amortization.
Yep.
So what happens at the end of 5 years?
Just means you have to reevaluate that loan in some capacity. So most of the time, the local bank that we would align you with will take a look at that deal again, give you another 5-year term, and move on. It's not guaranteed. They're going to, again, evaluate it as if it's a basic refi. Mm-hmm. Or we may find you another better lending solution at that point, but it's 5 years from now. Mm-hmm. I would say a lot of investors tend to turn their loans a little bit faster than someone with their primary residence. Mm-hmm. And so honestly, 5 years, potentially even a 10-year term is enough time to get done what they need to, start paying down that principal balance with the tenant's rent, have some appreciation happen on the property, and then we can do different things in the future on that property. But I would say, to highlight back what you were saying, it sounds like there's going to be more effect on the rate side than there really is going to be on the term side. And it looks small. Mm-hmm. It looks pretty small. A full percentage point difference in rate, and we're talking $55 a month. So I think as a newer investor, you really have to figure out, is this property cash flowing in a way that makes me comfortable as it sits currently, or do I need that $55 a month additional cash flow for this deal to make sense?
So I have a few investors. Well, I have a lot of investors, but they're all across the board. And so like a good question is like that $55, when is that important? If your total cash flow is $55, then it's really important.
Yeah, touche.
But if your total cash flow is $55, do you really want to be in that deal to begin with?
No.
I would say like let's say you're trying to buy $130,000 properties, or the ARV is at $130,000. I've talked about them before, but my guys that are buying in Montgomery, Alabama, they shoot for $300 a month in cash flow after a manager.
Yeah,
in
that's
place.
pretty standard.
Yeah.
I would say most of my investors, same thing, $300. And I think that's something that some people are unaware of. I think they're maybe thinking that they're going to get $400, $500, $600 in cash flow. That is not really the case. I would say 300 is kind of that mark that most people are trying to hit. So if you're less than that, that deal's skinnier. And I guess my other statement is, okay, one deal that's not cash flowing at 300 is fine.
Yeah.
You get 10 deals not cash flowing at those marks is where this starts to potentially, if an expense happens on the property, it's going to start eating into your own pocketbook. And that's not the goal of investment real estate.
Yeah.
Again, you want to try to keep your personal finances out of it as much as possible.
Yep.
Alternatively, if we're looking at a certain deal, are there certain terms and conditions that really drive if the deal even makes sense at all? Are there certain types of transactions where clients are going to be using, a certain product to even make the transaction make sense?
Sure. Yeah. I mean, we see that all the time with hard money. I mean, if you're going to buy a house that has value add, a property that has value add, there are plenty of loan products that are not going to work.
Yeah.
So it's really going to be the terms of a hard money loan that'll make it possible.
Yeah, they're so flexible.
Yeah.
Yeah, so you're gonna be in a short-term loan with no prepayment penalty, and you're gonna be making interest-only payments. And so all of those flexibilities, and wait, biggest part, the whole deal itself is based off of the structure of the property. What that purchase price is, what the rehab is, what the after repair value is, and that gives you these great terms and conditions that allow for short-term financing and interest-only payments that allow you to transition while you're rehabbing the property. So are you hearing more about interest-only recently?
Yeah. I mean, sometimes people are looking at like interest-only payment options for long-term loans. So if we're looking at interest-only options for long-term loans, why would you do that? You would maybe do that if you knew you were going to turn this property around in 3 to 4 years.
Yeah.
So like, for instance, I have some investors. So in Columbus right now, the big hullabaloo is Intel is going in east of Columbus, right? And so I've had people that have been interested in buying properties in Johnstown, which is the little town where Intel is going up, and they want interest-only payments because at the end of the day, they are going to maybe do a little bit of rehab, maybe rent it for a little bit, but then in 3 to 4 years, once Intel is complete, they plan to completely sell it, and they don't want to necessarily have a rental in that area.
Are they cash flowing really well on those properties traditionally?
I mean, if you're at a 30-year fixed rate, you're on a 30-year fixed rate of, let's say, 7.5%.
I would say if they're playing off the appreciation game, they may be cash flowing very little. So this interest-only option gives them a little bit more room in these deals where traditionally there would be little to nothing.
Well, yeah. I mean, because if you're paying both principal and interest on a loan, where's that principal going? Okay, it's paying down the loan amount, but is it really impacting the amount of interest that you're paying? Not in the first 5 years.
No, it's all front loaded.
Yeah. In the first 5 years, most of your payment is interest. So that little extra $100 or $300 or $200 a month that you're paying towards principal is not going to really decrease the amount of interest that you're paying month to month, especially if you're only on a 3 to 5 year plan.
Yeah.
So sometimes it's better to, especially if you know that you're going to sell the thing in 3 to 5 years, just get an interest-only loan. You might pay a little bit more on the rate, but you end up saving that extra money each month in principal payments and putting it back in your pocket instead of waiting to get your money out of the piggy bank at the end when you sell that house.
Yeah. Okay. I will say that in that scenario, you are pretty much leaning very heavily on the appreciation side of things. So,
Sure.
Or assuming that appreciation doesn't decrease. And so when you're kind of pigeonholing yourself a little bit into that category, you just have to be really confident of the market that you're investing in. So this Intel game, I think a lot of people are pretty certain that there's going to be some strong appreciation. That makes sense. If you're in lower appreciating areas like myself, where I invest in Dayton, I likely would not go an interest-only route because I need that principal reduction to really see the end game net benefit of going that direction. But alternatively, Interest only totally makes sense on your short-term financing option. It's actually required in most cases. And then also in this scenario, those can really kind of change how those deals look, feel, and function.
So what's the bottom line in all of this? What do you think? I mean,
so I think it really comes down to being flexible. I think
Yep.
as a new investor, you're here to learn, and to be honest, practice as much as you can, evaluate deals without going into contract. All of these numbers and evaluations can be done well before submitting a purchase, a pre-approval, and getting into contract. But practice so that you can understand what transactions matter more about the deal, what transactions matter more about the term, what transactions are heavily driven by the interest rate. And I think it's being really flexible and fluid to say, oh, this transaction, the term is what is going to determine if this thing makes sense or not, or for them. And that's the biggest thing. And I think too often investors can be kind of stringent in, oh, well, it has to fit in this box. No, not in our space. It's really being fluid with, you have these facts. What is going to be the driving force that makes this a good deal for you? What's your opinion?
yeah, I mean, it's like, should you be married to the rate? No.
No.
Should you be married to the amortization schedule?
No.
Should you be married to the property? Not necessarily,
No.
right? I mean, at the end of this, what are you trying to do? You're trying to build wealth, right? And how are you going to do that? You're going to use all the tools that are available to get the best option. So, like, here's one that I see a lot. I want the lowest rate. I want a 30-year fixed rate. And I also want the shortest prepayment penalty.
Not going to happen.
And it's like, okay, well, wait a minute. Like, I can give you a lower rate on a 5-1 ARM instead of a 30-year fixed rate because you're telling me that you 100% believe that rates are going to go down and you're going to refinance in 3 years.
There's so many aspects where it's about the person and
Yeah.
what they think about the market and they think about the property and the appreciation. There's so many factors that us as a loan officer can only guide you so much. And I lean on clients a lot of, tell me the story for this property. Tell me what your plan is, because I think that's going to help us lead you to the right product for you. But we can't know that information without some guidance. So I think start to narrow down what the goals are of looking at a good transaction, what is going to say, yes, I want to move forward. And then we'll guide you to say, okay, these terms make sense. I love that you made that point of like, hey, they want everything. That's
Yeah.
not an option.
Yeah.
It's that phrase of like, I want something done quick, cheap, and fast.
Yeah.
No, quick, fast, cheap, and good. I want it
Yeah.
to be good quality. I want it to be as cheap as possible. I want it done quickly.
Yeah.
It's one of those scenarios. You're not going to get all of those things in one package. So what of those three things are the biggest importance?
Yeah.
Narrow it down, give it to us, and we'll give you those terms that mimic those ideals. So can't wait.